Well, hello and welcome everyone to our client webinar, Understanding the Secure Act 2.0. We're so happy that you guys could join us today on this beautiful Thursday afternoon. The webinar will be recorded and I'm going to place it on our website once compliance approves it. The Secure Act 2.0 is the most significant piece of retirement legislation since the original Secure Act that was approved in 2019. The secure means setting every community up for retirement enhancement. So without further ado, let's jump into these changes. It has roughly 100 provisions, mostly around retirement plans. So we need to first get our arms around the key changes and assess the implications. The good news is there are numerous benefits to investors relating to more time to save, more ways to save, and more ways to use those funds. The challenge is simply absorbing the depth and timing of these changes. Since most of these provisions are effective in 2023 and 2024, however, others are pushed all the way out to 2028. So today we're going to place our findings under one big umbrella and highlight key changes that you should know about. So let's dig in.
All right, today we're going to go over the highlights of the Secure Act Parts 1.0 and 2.0. The first part passed into law in December of 2019, and version 2.0 passed this past December in 2022. Their impact is far-reaching, from the silent generation and boomers thinking about estate planning to boomers and Gen Xers focused on retirement, or millennials and Gen Zers who will be the recipients of great wealth transfer in the coming decades. As we all know, taxes are complex and they impact your savings, investments, and retirement plans. Generally, the new rules are very savings friendly. However, they require everyone reevaluate their financial plans in order to capture the opportunities presented. In addition, the government sees businesses as the conduit to help expand and promote retirement savings by their employees. So we want to make sure you understand how the changes will impact you, your family, and if relevant, your businesses. So let's get started now, Casey.
As most people know, everyone's tax situation is different, so you should always consult a qualified professional tax advisor to discuss your specific tax situation. We are financial advisors and we don't provide tax advice. What we do is help people understand how their tax code and other rules could impact their financial planning and investment. And then we develop a plan for retirement that takes taxes into account.
Now, you may be thinking, what parts of the Secure Act will specifically impact me and my plans for retirement? So that brings us to our first key.
The Secure Act is giving you more time to save for retirement and provides great opportunities to save and reduce taxes. So what does more time to save mean? There are a number of positive changes to age limits, some allowing you to contribute longer to your plan, and others allowing you to hold off on taking mandatory withdrawals from your retirement account. Let's take a closer look.
In the past, savers were forced to withdraw money from their IRAs starting at the random age of 70 and a half. Whether they wanted to or not, these withdrawals had to come out, and they're called required minimum distributions, or RMDs. The Secure Act has now increased the age you start taking these forced distributions all the way out to age 75, depending upon your current age. As you see on this table, anyone currently subject to and taking RMDs must continue their existing schedule. So if you were born before 1951 and turned 72 in 2022, you should still take your first RMD by April 1 of this year, 2023. And if you were born between 1951 and 59 and are turning 72 this year, your required withdrawals start next year when you turn 73. It's worth noting that you see a star on the table next to the year 1959. And that's because we've confirmed there's a clear mistake in the law that would have some folks starting their RMDs at both age 73 and at age 75. This will ultimately have to be rectified by the Congress and the IRS in a technical correction. So for now, we're going to assume we're working with age 73 for that group. Those born in 1960 and later will not start taking RMDs until age 75. This gives your money more time to hopefully grow tax-free. Remember, however, building up large IRAs means larger RMDs in the future, which can have tax consequences when it's time to start drawing down your retirement assets. This is one of the topics we'll discuss if you come in for a one-on-one meeting, but we're not going to go over it here tonight. In the past, failure to take a prescribed RMD resulted in a 50% tax penalty, though you could fill out a form and contest it. That has been reduced to 25% with a 3-year look back, and further reduced to only 10% if you correct the error in a timely fashion. Lastly, the new law eliminates required minimum distributions for both Roth 401ks, 403bs, and 457s, meaning or matching the rule for Roth IRAs. So the question becomes more about the benefits of rolling the plan over into an IRA, considering investment options, fees, and services, etc. All good news here.
The primary benefit of a new rule would apply to older surviving spouses who now can assume a deferred RMD start time. The benefit, if they don't need the money, they can delay withdrawals, allowing the potential for the account to grow. Another benefit is that the RMDs would also be smaller than if the surviving spouse treated the retirement account as their own. Remember, RMD percentages increase with age. If the surviving spouse passes away before RMDs begin, the new 10-year RMD disbursement rules don't apply, meaning the eligible designated beneficiary could stretch the payouts over their lifetime expectancy.
Previously, you could only contribute to your IRA until age 70 and a half, and then you'd be forced to start withdrawals. The new legislation gives those wishing to work longer more opportunities to save and the potential to create a larger nest egg when they finally retire.
First, in 2024, the catch-ups will now be adjusted for inflation. Second, starting in 2025, a special enhanced contribution has been created for a very narrow bracket, those from age 60 to 63. In that bracket, you can contribute to a 401k or 403b an additional $10,000 or 150% of the regular catch-up amount. Or for simple plans, you can contribute an additional $5,000 or 150% of the regular catch-up amount.
The table frames the catch-up contribution changes by age. So 49 or younger, the catch-up is not available and never has been. The standard catch-up is for those 50 to 59 or 65 and older, and this year it's $7,500. Special treatment, though, for those 60 to 63 begins in 2024, where they can contribute either the $10,000 or 150% of the then standard catch-up provision starting in 2024. The bottom line is that the rule changes allow for participants in IRA, 401k, 403b, and simple plans to contribute more to their plans each year. So if you can keep setting money aside, that's great news. You'll defer your taxes and grow more savings for your retirement years.
If you're thinking these new rules make me think I should consider putting more money aside for retirement, it's a good thought because that's what the Secure Act rules help people do, including now Roth plans at work, auto enrollment in plans, helping for part-time workers, and helping for young families and professionals. So let's take a look.
Aside from more time to save, the Secure Act now provides more options to invest for your retirement. In the coming slides, you'll see many changes to workplace retirement plans. We'll explore this important component and how they relate to your retirement funding efforts.
There are a significant number of changes related to Roths, both for personal retirement IRAs and in employer-sponsored retirement plans. Starting in 2023, the addition of employer contributions to the Roth side of the plan equation is a great opportunity to build assets that will escape taxation when withdrawals begin. However, it's important to note it is not mandatory or automatic for employers. Offering you matching after-tax contributions to the company Roth plan are entirely at their discretion. For those employees making more than $145,000 annually, your only option to have catch-up contributions is to a Roth account. The only exception is if the plan doesn't offer a Roth option. Remember, RMDs are no longer required for Roth 401ks, 403b, 457s starting in 2024.
Starting in 25, to encourage increased retirement savings, your employer is required to auto-enroll you in their 401k or 403b plan. Then you'll have the chance to opt out if you like. In year one, the employer will determine how much of your salary they can allow. They can allow you to put aside for savings. It'll be between 3 and 10%. In year two, that number will increase to between 3% and 15%. In addition, that number will auto-escalate by 1% annually. Those new to the workforce or changing jobs in 2025 stand to benefit the most. Studies have shown that auto-enrollment is increasing 401k balances. So Congress wants to continue their good work, but we all know the earlier we start, the greater the potential to create money for retirement. This might be a good time to look at your own 401k savings and consider if you are saving enough and if it's in the right places. How much will your employer match is another consideration. Some business types are exempted from the auto-enrollment requirements, and this is something we can discuss later on. Oh, I'm stuck. There we go. Companies will now have more freedom to offer annuities inside 401k plans. Why is this important to you? Well, one of the hardest parts of retirement income is making your total savings last the rest of your life. Annuities are insurance products designed to turn a portion of your savings into a stream of income that lasts a lifetime. They can be a very interesting solution to help address the question, will I live to an advanced age and run out of money?
The new legislation is casting a wide net and providing small businesses another way to attract, retain, and help their employees save for retirement. They now have a starter 401k, which is a good place to start, though it may not be as attractive as the traditional plans because employers are not required to match your contributions and contributions are lower. It is, however, a path in the right direction to help boost your overall retirement savings.
The new legislation is casting a very wide net and providing small businesses another way to attract, retain, and help their employees save for retirement. The starter 401k plan, we did say that, sorry.
They also now have 401k plans for part-time workers. You have to be working for at least 500 hours for 3 consecutive years or 1,000 hours throughout the year.
For 2023, the Secure Act adds 2 new options for Roth contributions to simple and SEP plans. Although it won't be a requirement for you as an employee to put this in place, it's there if you want to take advantage of it. Effective in 2023, you can offer your household employees, a nanny or a cleaning person, a SEP IRA plan. That would be a nice benefit depending on your personal financial circumstances. Simple and SEP plans for Roth provide a simplified way for a small business with 50 or fewer employees to contribute toward employee savings and yours if the business owner. Previously, simple and SEP plans only allowed for pre-tax funds, which were taxed when withdrawn. Additional employer contributions will be allowed for simple plans in 2024. They'll be capped at $5,000 per employee, in addition to the required matching or 2% pay of the elective contribution. Once again, there may still be good reasons to roll over a simple or SEP into a Roth. The availability of investment options, fees, and service should all be considerations. This law passed in just 2022, so it's going to take some time for participating employers and importantly their vendors as well to set up the systems and procedures to be in alignment with these IRS rules.
These rules are especially beneficial for new families and young professionals. They now allow to help build emergency savings, though highly compensated individuals are ineligible. The money in the emergency savings account must be held in cash or a cash equivalent, and participants must have monthly access to the funds. Many Americans don't have rainy day funds, so the emergency savings account can provide a way to regularly set aside money every year for unexpected expenses. And you get to do it using your retirement plan. While it is only offering you $1,000 annually, the definition of what they qualify as an emergency withdrawal is broad and seems to account for many different circumstances.
There is a new student loan repayment match where employers can help employees who are paying off student loans. An employer can make a matching contribution on behalf of the employee in a 401k, 403, 457b, or simple IRA with respect to qualified student loan repayments. This begins in 2024. In addition, younger earners can start contributing to an IRA with an expanded definition of earned income. A great example is that stipends and non-tuition fellowship payments to graduate and postdoc students will count as earned income for the first time. This means that postdoc and grad students can contribute to IRAs as well. This is good news for students who will want to begin accumulating tax-favored retirement savings. In many cases, graduate studies, I should say, keeps them far too busy for a regular job that might offer a 401k or other employer savings plans.
Your 401ks will also have a new disclosure, which will show you how your total savings will translate into monthly income. This can really help with our discussions about your retirement, especially future cash flow and income you'll need.
Now, you may be saying, I see how I'll have more time to save. Can the new rules actually help me in other ways? And the short answer is yes. The new legislation has made sweeping changes to how you can use your money, from 529 conversions to funding long-term care. So let's explore a few of the most prominent changes that you need to know about or that have broad application for investors.
We all want to feel smart and responsible about how we handle our money. We're now going to share some parts of the Secure Act that will give you some new ways to use your savings. You'll have new options for making your charitable donations more tax efficient. You'll also going to be able to maximize college savings accounts, also known as 529 plans, in new and interesting ways. And finally, there are some new reasons that allow you to take money from your retirement account if you need to without paying a penalty.
You may be familiar with qualified charitable distributions, or QCDs. And if you're not, they were introduced in 2006 to help people 70 and a half and older to satisfy their required minimum distributions, the RMDs we've been talking about, by making a charitable gift with the money in their IRA. If certain rules are met, they can directly transfer up to $100,000 annually from the IRA to a qualified charity of their choice. And again, that donation would satisfy the RMD requirements for that year. Effective in 2024, the new law maintains the maximum transfer at $100,000, but it'll begin to being adjusted for inflation annually. Now, it's important to note that it must be a qualified charitable donation. And it's best to check with your tax advisor because there are some organizations like private foundations that are ineligible for donation under this law. Beginning this year, 2023, the new QCD law also allows for a one-time only ability to fund what's called a split interest entity, which is beyond the scope of this conversation, but up to $50,000. It's quite technical. We're not going to talk about this, but we can do that offline.
The new rule changes allow you to use money that was originally set aside for your kids' or grandkids' education. So you no longer need to dig into your savings that was earmarked for retirement. You can now use the 529 education plans up to $10,000 to repay student loans. We all know that student loan debt is a crisis in America, so this new provision is one way that savers may find relief, allowing them to put less money towards student debt and more towards retirement savings. A related change is that the 529 plan monies can also be used for apprenticeship programs, provided they are registered with the Department of Labor. Remember, some kids don't go to college, but still need money to prepare themselves for workplace. So they can use the 529 plans that the families originally funded. And if you forgot, you can use $10,000 per year to cover private kindergarten through 12th education using the 529 plans that was established in 2017.
Do you have or anticipate having money left over in a child's 529 plan? This new rule could make it easier to save for your kids' college and jumpstart their retirement savings too. Here are the details. Excess funds in a 529 can now be rolled over directly into a Roth IRA for your child, the beneficiary. The beneficiary must have earned income. As with other rollovers, you're not taxed on the transfer of the funds, and the money continues to enjoy tax deferral until withdrawn. Beginning in 2024, you can roll over up to $35,000. That's a total lifetime max from a 529 plan to your child's Roth IRA. The annual transfers are also subject to annual Roth IRA contribution limits, currently $7,500. Another benefit to this rule is that there are no income limits for participants, meaning while high wage earners earning $144,000 or more as a single or $223,000 or more for a joint filer usually make too much money to contribute to a Roth, they will now be eligible to do so for their kids or grandkids with leftover 529 money, and they will not have to do a backdoor Roth conversion to get this done.
Several new items have been added to the list of penalty-free withdrawals you're allowed to make from a qualified retirement plan before age 59 and a half. You can pay for long-term care insurance now using this. This is a tremendous benefit for a few reasons. As we age, more and more of us will encounter a major health event that requires long-term care, such as in-home medical assistance or a nursing facility. The high cost of care for an unplanned critical illness can be catastrophic for families, and unfortunately, Medicare really doesn't cover much. The average cost of a private room in a nursing facility can be $100,000 or more, depending on where you live. But many people forego long-term care insurance because they think it's too expensive. But as you can see, so is the cost if you're caught by surprise. This new rule now makes it more affordable and tax-friendly, but clarity is needed from the IRS about the type of long-term care insurance that is qualified under this rule. The law is vague, referring to it only as high-quality LTCI. If you do have financial concerns about your family health history or your health issues, please set up a meeting so we can discuss this.
Okay. We now have some broadened exposure to penalty-free IRA withdrawals. The new law states that parents may withdraw up to $5,000 from a retirement account for a qualified birth or adoption without a 10% early withdrawal penalty. The withdrawal must occur within 1 year of the birth or adoption, and you will likely still owe taxes on the withdrawal.
There are also several new provisions allowing for special circumstances for penalty-free withdrawals for someone who is terminally ill, a victim of domestic abuse, or for public safety workers, which now include firefighters and others. There's also been provisions made for expenses coming from a federally declared natural disaster. This rule is actually retroactive to disasters occurring in 2021 and later, and allows for a maximum distribution of $22,000, which may be taken and repaid over 3 years. Retirement plan loans for people living in disaster areas have also increased from $50,000 to $100,000.
Okay, undoubtedly there are some of you in the audience who have already accomplished saving enough for retirement, and kudos to you guys. Now, you're starting to think about the next generation in estate planning and wondering, what do we need to know about leaving our IRAs to our kids? Is that still allowed in these new rules?
Unfortunately, Bob, the news here is not good. Our fourth key point is your kids can still inherit your IRA, but you can only defer taxes up to 10 years. This was a big rule change in 2019, and it's worth addressing today. Not only are your retirement savings affected by these new rules, but the death of the stretch IRA requires a review of your estate plan thinking. Let's look a little bit more closely.
With certain exceptions, which we'll see in a moment, beneficiaries of IRAs, including Roth IRAs, must liquidate the accounts within 10 years. Previously, IRA owners were encouraged to have younger beneficiaries, I should say, because they could stretch out the distributions over the beneficiaries' lifetimes, allowing for longer tax-free growth. Some heirs even plan to use the accounts for their own retirement. but now they must take out the money within 10 years of the death of the original owner. This could have major repercussions for the beneficiary. When they withdraw that money, they will have to report it as income and pay taxes. This is not true of Roth, of course. This could also affect the FAFSA, the the free application for federal student aid, or known as student loan application form, if they have children applying for college financial aid, and possibly limit their ability to claim certain tax credits. There is no clear ruling so far about how to draw down the account provided it is gone within 10 years. The beneficiary could take some out each year, over 10 years, or none for 9 years, and then everything. There is some belief that the IRS will in fact require annual RMDs, but that is still unclear. Planning is needed, and this should include consulting your accountant. If you have a large IRA balance and know it'll be part of your estate, please catch up with us afterwards so we can talk about strategies.
As we said before, there are some exceptions to the 10-year rule, or what the IRS calls eligible designated beneficiaries, EDB. They include surviving spouses, disabled or chronically ill beneficiaries, those who are not more than 10 years younger than the original owner, and minor children. And in that case, the 10-year clock starts when they reach legal adulthood and doesn't include grandchildren or other relatives of the original IRA owner. For all those eligible designated beneficiaries, the stretch IRA is mostly business as usual. The new rule also does not apply to people who have already inherited an IRA, only those inherited in 2020 or later.
The real lesson from all these changes, particularly the death of the stretch IRA, is that tax planning is more important than ever. Congress is looking for ways to increase revenue, and one way to do it is to eliminate tax breaks. We'll likely see other changes before the time comes for you to retire or pass on your estate. For many years, even decades, people were told to rely on IRAs. And most of us have listened to the point where, helped by a 10-year bull market, they've accumulated a lot of money. The problem is one day the tax bill will come, and you can't predict what the tax bill will be when it does. As I've said, I'm not a tax professional. We do give guidance, but not advice. All tax decisions should be reviewed by your accountant. But we can look at your investments and savings and help you plan ahead. Taxes and retirement are a much bigger issue than many realize. There are a lot of gotchas. We can help you develop a retirement income plan so that you draw down your accounts in a tax smart way. Some of our strategies might include Roth conversions, using your tax brackets
This is me calling you.
plus, and creating a state
Talk to you later.
the best sense for everyone in your life.
So hopefully we've conveyed to you the importance of the new retirement rules brought by the Secure Act, and you can see how important it is to focus on what's going to be most impactful for your life.
Messages, press delete
You're
again.
probably wondering, what are the next steps?
So
What we're gonna do
In fact, there are 2 deletes. So this thing works now.
Okay. Did you read this one?
Mhm.
Okay. We started our presentation by saying the Secure Act changes the retirement rules, and that means current and future retirement plans need to be reviewed, possibly and likely adjusted. Our first key point, the new provisions of the Secure Act give you more time to save for retirement, but you need to know how these provisions work so that you can take advantage of them. Secondly, it gives you more ways to save for retirement. Our third key point was that it provides smart and responsible new ways to use your money. And fourthly, the death of the stretch IRA means that your kids can still inherit, but they can usually only defer taxes for up to 10 years. Failure to get the money out in a timely manner can be very, very costly.
So we covered a lot today, and we hope that you can agree that these new rules are sweeping, widespread, but yet mostly positive. Since everyone's tax situation is different, it is important to talk with your tax advisor. Bob and I do like to work with people's tax advisors, and we have been doing that for many, many years to make sure that our recommendations also align with what they think is best for you.